Let's start with an obvious truth. Real estate is not a get-rich-quick scheme. However, if done right, it is one of the most consistent wealth-building tools out there. In fact, 90% of millionaires grew their wealth through real estate. If, like me, you're looking to diversify your portfolio or reduce your investment risk or just get out of the volatility of the stock market, you are speaking my language. But here's the catch. Most people get stuck because they're overwhelmed by fears and complexities. I like to think of myself as financially savvy and pretty darn good at spreadsheets and in control of my finances, and yet it still took me 18 months before I jumped into my first deal. I kid you not, we drove around and looked at 100 different properties, walking through all of them. We even saw some really good deals, but ultimately I didn't pull the trigger because I had some fears and concerns. And perhaps you're asking yourself similar questions that I asked. What if I lose money? Or what if I choose the wrong property? And can I trust the person in charge of the property or the investment? If any of this sounds like you, you're not alone. So I'd like to address those fears and provide some actionable advice so that you can jump into your first real estate deal with confidence, whether you want to dive in actively or passively. I'm James Furlo, providing strategies and tools for real estate investors to maximize their long-term cash flow while minimizing headaches. Thanks for watching. Fear number one, I'll lose money. Look, I get it. Nobody wants to lose money. And if you come from the world of the stock market where it's just the classic up and down and it has all the volatility, I get that you do not want to do another version of that roller coaster. Here's the good news. Real estate is so much more predictable, and as cornerstones, it has appreciation, tax advantages, and cash flow. But let's not sugarcoat things. There are still absolutely risks in real estate. So, how do you mitigate them? Two things: underwriting and due diligence. I start by running my numbers. And whether I'm investing actively into a rental or passively into a syndication or as a money lender, knowing some metrics is really, really important. Metrics like your cash on cash, or your average annual return, or your net operating income, or NOI. Knowing those keep me out of bad deals. I fall in love with the deal, not the property, by focusing on the math. If I'm investing actively, I like to have reserves, and I like to factor in 3 to 6 months of expenses as a backup cost, just so I'm prepared for any time that there's a vacancy or some unexpected maintenance or just rent weird fluctuations. And here's a pro tip. If you're looking to minimize risks even further, consider investing in a turnkey rental or a syndication where an experienced operator, such as myself, does all the heavy lifting. Fear number two, I don't know how to get started. Now, this is the classic analysis paralysis. Before buying my first rental, I read dozens and dozens of books. And I love reading, so it's all good. But had YouTube been around, I probably would have watched hours of videos trying to suck up as much detail about the entire process as I could have. And don't get me wrong, I loved real estate. I thought it was going to be the best thing ever, but I was so afraid of making a mistake that it held me back for 18 months before I finally did a deal. And technically longer, since I actually waited a couple years doing all that research before I actually started looking. Don't do that. Now what I tell analytical folks is don't worry about all the details, just learn enough to take the next step. One of the things I've learned is that real estate actually moves pretty slowly. You will have plenty of time to learn and figure out the next step. I promise. Start small, learn as you go, and lean on other people's expertise. One really small way that you can get started is to partner with someone else who's already done it. They can help you with the acquisition, the financing, and the management. And another really nice perk of partnering with someone like myself is that they know how to do the underwriting. They're not going to let you invest in a bad deal because, well, I don't want to invest in a bad deal. In fact, passive real estate investing, like in syndications or money lending, could be a fantastic option for someone with a busy lifestyle. If you're the type of person who has a full-time job and a family and just doesn't have the time to be hands-on and learn all the complexities, this path allows you to actually invest in real estate while avoiding all the complexities of things like tenant-landlord law and property maintenance. Fear number three, I don't want to deal with tenants. Now I get this is a huge blocker for any would-be active investors. I mean, who wants to deal with the late night phone calls about a leaky toilet, or deal with evictions, or just deal with unresponsible tenants in general? I totally get it. And there are actually 3 options, so you don't have to deal with this. First, screen really well for responsible tenants. Set an income requirement for at least 3 times the rent, and then treat them the way that you would want to be treated, and communicate frequently. You'll find if you do this, it will resolve 99% of tenant issues. Second, you can choose to invest passively in either a syndication or as a private money lender and avoid tenants entirely. Leave it to the professionals to deal with all of that. The third option, if you still want to be an active investor, is to simply hire a property manager. And for about 8 to 10% of your monthly rent, they'll handle everything. They'll take care of the tenants, they'll take care of the maintenance, the bookkeeping, everything. Now, you still got to manage the manager, but as long as you connect once a quarter, it'll be fine. So this begs the question for fear number 4, can I trust the property manager or the sponsor? Trust is a huge factor. You need to be able to trust that the person who you're handing over the keys to your property or you're giving your money to invest is trustworthy and that they have your best interests at heart. Here's where due diligence comes in. Always research the sponsor's track record. Well, how did they do? And ask about how they'll handle hard situations. Now, to help you do that, there's a link in the description to 196 questions that I put together that passive investors can ask their sponsor. I think you're going to find it pretty comprehensive and super helpful. And here's my final advice. Take a small step now to get clarity. My go-to first step is typically to read a book. Now, I get it. It's a lot slower than other options, but I'm a bookworm, so it works. Another really good option is to talk to someone who's already done it. But then, sooner rather than later, take an actual step towards your goal. And it's totally okay to be uncomfortable. That's actually a good thing. It's a sign that you're growing. Like if you're looking to be an active investor, find a property on Zillow or the MLS and actually call the listing broker and just ask about it. You're not looking to buy it, you're just there to learn, to take the step. If you want to invest passively, find a sponsor like myself and either sign up for their email list or set up a meeting to talk with them. You don't have to invest immediately, but now you're in the flow and can continue learning. Expect to make mistakes and celebrate those small wins. You got this. And if you found this video helpful, please like the video. And if you want more strategies and tools for maximizing your cash flow while minimizing headaches, please subscribe. Thanks for watching.